Hello, I'm Giles Coghlan, macro strategist at Seasonax, and welcome to this edition of the Seasonal Deep Dive. Today we're going to explore one of the most consistent, yet often overlooked, seasonal effects in global markets, and that is the turn of the month effect. It's a pattern that appears across asset classes from equities and commodities to FX, and understanding it can give traders a real timing advantage. So, what is the turn of the month effect? In simple terms, it is the tendency for markets, especially equity markets, to rise in the few days around the turn of the month. Typically, the last few trading days of one month and the first few trading days of the next month. So, why does this happen? Well, a big part of it comes down to cash flows. At the start of each month, we see salary inflows, pension contributions, ETF savings plans that are automatically invested into markets. Institutional investors often allocate new capital at this time. So these inflows create a liquidity boost that can push prices higher, especially in major equity indices. So before we look at some data here for the S&P 500, a quick reminder of how to read our Seasonax event charts. The blue line here shows the average price path during the event. In this case, the event we're looking at is the turn of the month. The horizontal axis represents trading days before and after, and the red line is the turn of the month. And what we're looking for here is the turn of the month effect in the S&P 500. So when we apply this, if we look at the first 4 days before the turn of the month and the 4 days after the turn of the month, we can see that there's historically been an average return of 0.5%, 63% winning trade percentage, and you can see that the cumulative return has been significant over the last 10 years. And this cumulative profit chart shows you how these cumulative profits stack up, highlighting how the turn of the month has historically delivered outsized performances. We can see that this pattern is similar not just with the S&P 500, but we can also see the pattern here in the DAX. In the last 10 years, around the turn of the month, you can see there's been an average return of 0.25%, and you can see that the cumulative profit again has shown a steady gain. But the pattern doesn't stop with equities. Take gold, for example. Our Seasonax data here shows a consistent upward bias in gold around the turn of the month. This reflects broader risk sentiment shifts as investors rebalance portfolios and move into perceived safe havens. You can see here, over the last 10 years, there's been an average return of 0.68%, a steady cumulative profit gain around the 3 days before and the 3 days after the turn of the month. Looking at individual equities, what we notice there's some large tech names that do show a strong turn of the month performance too. For example, Apple, you can see here in the 4 days into the turn of the month and the 3 days out of the turn of the month has an average return of 0.64% and a steady cumulative profit gain. We see a very similar pattern with Microsoft, an average return of 0.44% in the 3 days into and the 4 days out of the turn of the month. By contrast, if we look at some more traditional cyclical blue chip stocks like Caterpillar, maybe Coca-Cola, they experience slightly steadier, smaller gains. Remember, blue chip companies are from companies that are large, well established, and financially sound. And these companies have strong brand names and reputations, and they generate dependable earnings. Blue chip companies often boast consistent dividends and are often considered less risky given their financial stability. But they still benefit from that early month liquidity bump, even if it is slightly smaller. You can see here Caterpillar 3 days into and 3 days out of the event got an average return of 0.38%. Similarly, with the Coca-Cola company, we see an average return of 0.29% in the 3 days before and the 3 days out of the turn of the month. Even in FX markets, the turn of the month effect can show up repeatedly. If we look at the dollar index, for instance, corporate and institutional flows plus hedging adjustments tied to month-end rebalancing can drive predictable currency moves. For instance, dollar weakness into month-end, you can see that bias for dollar weakness in the 3 days into the end of the month and the 6 days into the end of the month. But that often reverses sharply once we move into the start of the month, and you can see that there's some steady gains at the turn of the month. So dollars down to end the month and up to start the month. So the turn of the month effect is both simple but a powerful reminder that calendar-driven flows can shape market behavior across a variety of different asset classes. And this is just one of thousands of seasonal patterns you can uncover with Seasonax. From annual events like earnings cycles, central bank meetings, to intra-month effects like this one. You can also break down the different months of the year. So you can see, for instance, what the difference is the first day of September, October, November, and December to get an even more detailed analysis of the data. If you would like to find out more seasonal patterns like this, go to seasonax.com and start identifying your next trading opportunity using data-driven seasonality insights. Thanks for watching, and I hope to see you in the next seasonal deep dive.